At this conference, every year, we have a panel of investors, and we ask that panel of investors their views on the markets, on issuers, on the way things are going. But it occurred to us, thinking about this year's event, that there are so many things going on in the asset management industry itself that maybe it was worth changing it a little bit this year and getting a panel of investors and asking if you're all okay with this, with everything that's going on. To help me discuss this and the state of the asset management industry and its implications, we have 4 investors representing different asset classes, but all basically from a portfolio management or CIO kind of perspective. So on my left, Lucette Yvernault from Fidelity International, Lucy Walker from Sarasin and Partners, David Katimbo-Mugwanya from EdenTree Investment, and on my right, far right there, James Bevan from CCLA. Hello. Thank you very much all for joining today. When I speak to investment bankers, what they've been bleating on about for most of the last year has been MiFID and how much it's changing their business model, the way they go about things. But you're kind of at the sharp end of this. In practice, in reality, how much has it actually changed the way you go about your day-to-day job? Lucy?
Personally, it hasn't thankfully affected me too much, but my colleagues internally have been affected quite dramatically. So my compliance department has certainly grown considerably since the MiFID regulations were first sort of introduced and even before that really with the dawn of regulation. And within asset management, I would say the administration around organising meetings and ensuring that our dealing is of course all done in accordance with MiFID, that has all increased considerably. But for me personally on the investment side, actually it's really been my colleagues in other areas that have sort of taken the brunt of it, as it were. But I would say that, you know, in general on the asset manager side, MiFID shouldn't really increase the day-to-day workings of the investment side unless that firm was sort of not operating well, shall we say. So the firms that are operating well on the asset management side are hopefully will have less of a burden than certainly the investment banks have found out.
But have you got a lot of compliance officers, presumably they're there doing something? Are they sending you more and more messages about what you can and can't do, or how you should change behaviour, or just checking on you?
The reporting element, I think, is a big one. So the reporting for clients, which, I mean, from what I understand it, the client side haven't actually necessarily found useful the increase in reporting that they have seen. And so arguably the costs of that reporting will ultimately hit the end consumer, and to what benefit. You know, that seems to be a key question. So that's one part of it. Certainly the dealers have done a lot of work to make sure that obviously splitting out research and dealing costs. So that has been a big project. And I think probably the biggest issue has actually been the lack of clarity. So the lack of clarity from the regulators about what they really want, and much of it is open to interpretation. And so, to be perfectly honest with you, I think everybody is feeling their way through this regulation, and whether or not the FCA will ultimately come out with clearer guidance about what they ultimately want, because probably they actually don't really know themselves in practice how does all this stuff work. So I think that's kind of the key, is the costs have been, the burden has been up until this point reasonable, but it could be ongoing and increasing potentially as the FCA and others get more certain about what they really want.
Do you feel it's still uncertain?
Well, I think from Fidelity point of view, I mean, obviously traditionally Fidelity is very much an active franchise. So we have a portfolio manager who are somehow shy of showing the entire market what they're trading on a day-to-day basis. And piecemeal, you can aggregate, obviously, houses by houses, what people have been trading. So it's pretty much follow the axis in terms of what the manager want to do. For myself, representing the more quantitative strategy at Fidelity, obviously there's a massive advantage in terms of data exploration, liquidity indicators, and so on, which can be quite contemporaneous, fair enough, but we have definitively more data than we had in the past, and therefore the exploitation of this data is also something that we can combine into more robust product and more decisive strategy. So It's been a mixed reception, obviously, depending on which side of the equation you're sitting on. But I think it's moving forward. It's definitively the way to go, and therefore there's probably more to be had from exploiting the data as opposed to refraining from trading.
Do you know, I find MiFID quite refreshing insofar as the separation of responsibility to determine how you arrive at decisions and how you optimally trade for your customers is quite the right way it should be. And the premise that we should be purchasing inputs to the investment process completely blind as to whether it results in a trade with a third party is, I think, correct. Equally, the obligation that we have, both fiduciary and in law, to get the best possible price is absolutely underpinning the trust that customers have in us when we invest their money. So for me, MiFID is great news.
In theory.
No, in practice.
In practice.
We pay for the research, we just write a check. And if you said to me, what are the practical challenges of writing a check to the sell side and other research entities, it is that those who have traditionally vended research for money know precisely what they want to charge and what the charging structure looks like. I'd say a number of the investment banks still have not worked out very precisely what they want to charge for WAS. And that does leave a gap of expectation between we, who are saying, look, guys, we're perfectly happy to pay you, but we do need to agree with you the basis of contract. And they're saying, well, we'll sort it out at a future date. And you think, no, you won't. We're not going to pay anything until we formally agree.
I'd say for us at EdenTree, there are changes in process, yes. So automation, I think one of the key things about MiFID is sort of transaction reporting, the speed and the content. So if you're required to report something in 15 minutes rather than, let's say, at the end of the day or an hour later, you're going to find sort of it's harder to do manually. So a lot of that sort of process that was, let's say, manual, I mean, telephones, virtually no one deals on telephone these days. It's all execution, automated, either that sort of staging the order, but then also your execution venue has to communicate that in a very short time space. So to sort of do that accurately, one of costs, yes, in terms of putting in things like legal entity identifiers or LEIs, but then it's sort of communicating a price, communicating the sort of the venue, the execution stuff quite quickly necessitates quite a lot of operation. Automation, and that's been in-house development. That's been also getting external sort of approved reporting mechanisms in place. So where you're transaction reporting and you want to report to the regulator, you need, again, something added onto your automated system to then communicate that almost as soon as. So, I mean, the time frame is quite key. I mean, yes, research costs are definitely a key question, and of course EdenTree is not the biggest firm out there. Everyone's sort of been grappling with the budget issue. You can't talk to everyone, so you've had to sort of rationalize who you talk to, what do they cover, what areas of the market are you likely to miss out on because you're not speaking to everybody. So there's some element of like under-researched markets as well within that you sort of have to increase your analytical capability on the back of, let's say. So there's been a change, yes.
So on that research, how did you go about it? You presume you used to receive dozens of different banks' research, and then you had to make a conscious decision to write checks to this one and this one, or?
Yes, certainly. I mean, a lot of it last year was price discovery. So the fortunate thing was prices moved in our favor as, of course, people started out with numbers, almost putting a finger in the air, okay, we'll charge you 100 grand. But then that sort of came down, and you had a lot more firms, I guess, picking up on the sort of approach as well. So you had firms that were offering corporate access. So we believe in meeting management, sort of meeting them and assessing them on their merits sort of in person. So you had corporate access pickup, you had research aggregators as well. So paying one person that will give you access to a lot more other research venues. Some of it has been sort of just gaining more analysts, so taking on headcount in-house as well. So you sort of have to compensate. But again, I can't say this has sort of remedied the entire spectrum, particularly for the equities in the small cap space. I think there'd be unintended consequences of MiFID, as the FCA was discussing last week.
Well, one of the things the FCA said, I think, was that it isn't an economic cost yet. That investment banks are actually undercharging for research, and there's still a degree of trade inducement, which I think first time the regulator has said you need to charge more to the customers. But do you think that what you're paying for research is actually economic?
I think reality is we will find out as time goes on, and certainly the sort of latest musings from the FCA suggest that the sort of platinum packages that include absolutely everything, in fact the FCA may not allow that going forward, i.e. one price for absolutely everything. You know, you're going to have to itemise all individual relationships and all individual meetings and pieces of research, and so that will undoubtedly increase the burden and will force people to make that decision that you've just said, which is, what does this actually cost? What is this worth to us? Because up until now, that hasn't been necessary, or not in such an itemised sense.
It is a nonsense, though, isn't it, that the regulation should invade the turf like this? I mean, after all, if you were a provider of research services, premise that you have a relatively fixed cost base and therefore can vend your product to people who wish to purchase at a fixed cost price, I think is entirely reasonable and consistent with good business management. And this idea that everything has to be itemised and laid out just flies in the face of practical realities of funding a research operation and treating with customers.
Yeah, I agree.
But isn't that just if it's a cost centre in its own right? Obviously underlying the FCA's concern is that you're really doing this partly to just show face it's just a few £100 here, but actually it's still a subsidy,
Well, I
an
think
inducement to trade.
Credibility gap is that before unbundling took place, the buy side persistently overpaid for what it was receiving, and there were very large, not terribly good research departments and specialist salesmen who were taking the customer's money in the process. And I think what the FCA are having difficulty in reconciling is this observation of cost coming down very dramatically. And I completely share David's point that this voyage of discovery is actually leading to a significant compression of cost rather than simply a rebadging of cost. And for me, really the question is that if I were not going to an investment bank, let us say I wanted to go to an accountancy firm for a specialist opinion on a sector, if you were to price that way in terms of pounds per hour, you do end up with a materially lower fee than if you were to pay an wholesale side firm on the basis of the bundled commission tariff.
Suggesting that research departments might be spun out completely, separate entities?
They will certainly become independent, and they may well become cheaper, and they will become much more focused on delivering research that people actually want to buy.
You know, I've already seen research teams change and move around as a result of investment managers' decisions on where to put their research budget. So, you know, it has already led to movement there.
There's a far more positive message than whenever I ask bankers about MiFID, which I guess is a good thing. Can I move on to just generally more compliance? A friend of mine organises compliance conferences for a living, which is pretty thrilling stuff, as you can imagine. And he said that his big thrust this year is more conferences for the buy side. Up until now, all of his fees have come from investment banks. David, are you seeing more of this focus of compliance coming onto you, and what are the biggest areas of that?
Yes, we are seeing compliance. I mean, compliance budgets have definitely been growing. We are seeing more, I guess, stripping out what are we getting from each individual bank, what are we getting value for money wise. So I'd say, yeah, we are seeing quite a bit compliance head our way.
But also I'm thinking about the stuff on you. So some of the areas of things like ESG disclosure.
Yes.
The Commission, I think, was saying much more about how much more you have to do there.
Yeah, I mean, that's more a regulatory point of view, but that is definitely sort of increasing. So EdenTree, for those who are not aware, are SRI specialists. We have been for the last 30 years at least. But what you're seeing now in the industry, I guess at large, equities and fixed income, is that climate change is becoming much more big an issue. ESG risks as well. And within that, you're getting regulators starting to mandate asset owners to recognize the impact of these assets or the companies that they manage on the climate. I think last week, if not start of June, there was an Environment Audit Committee letter in the UK Parliament, sort of starting to ask the question about mandating UK companies to report climate risks. You had Mario Draghi last week writing a letter to the members of the European Parliament as well about the asset purchases that ECB has been making. What is the impact on the climate? I mean, they've purchased green bonds, and they are starting to sort of reference that. But in terms of what you probably see more of is asset owners such as ourselves being asked to recognize the impacts there. So yes, cost is one, MiFID has been a great body of work, but you're probably seeing more things in the pipeline along disclosure, and just to make sure we're aware of the impacts and we're also managing them, that we have strategies that integrate these risks into the portfolio management.
James, CCLA also an ethical investor historically. Are these reporting extra burdens, are they in line with what you already do, or is this something new?
The reporting is largely in line with our current work. I mean, I would suggest that we might regard environmental, social and governance factors as just additional forms of risk. And one might observe two drivers within our industry. One is towards greater transparency generally, and that is obviously all to do with the premise that we need to have informed financial consumers. And then allied to that is the premise that governments now want informed consumers to be much more responsible for the outcomes to which they expose themselves, rather than bleating at some later date that they didn't know what was going on and could they have some help from the government, please. And this twin challenge of greater consumerism and greater responsibility foisted on consumers, I do think means that the bar is going to rise ever faster and further in terms of what we have to do and what we have to say. But at the end of it, there is no fundamental shift from needing to understand the risks to which we expose our investors and then managing those risks carefully.
I don't want to say unethical funds, but not dedicated ethical funds on my left. Is it just another risk, or is this a market opportunity to sell more and different funds?
So, I mean, Sarasin is very definitely an ESG investor, and we have a team of 4 dedicated to researching the area, and indeed we actually have a climate active fund which is aiming to invest in companies which are all in accordance with the 2% target. So very definitely we are supporters of the increase in focus on an area which we have felt has been an essential part of investment for many years.
But those are in dedicated funds. It's more for your generalist funds that haven't got that specific mandate.
So for the generalist funds, our ESG team works extremely closely with our equity analysts, and so there we are integrating the process. So it's not a do your investment research first and do your ESG research later. The ESG team form part of the investment desk, which ultimately meets every week or speaks sooner, and so those conversations are being had at an early stage. Indeed, a new idea may get kicked out before it even reaches the kind of greater investment phase, because from an ESG perspective we can't look at it. So that's true for the equity funds. I run multi-asset funds and some fund of funds, and there it is more difficult to integrate ESG explicitly into your investment decisions. You can buy sustainable funds, but the universe there is still quite small. And so instead, I tend to consider ESG more from the perspective of interacting with boards, for example, with the investment trust, so thinking about it more from the governance perspective. And then we leave the sort of ESG or the ES side to the dedicated funds and more generalist equity funds.
Yeah, Fidelity is playing both in terms of equity, in terms of fixed income, in specialist fund, but also across the board. It's fair to say that we have had internally analysts raising the bar in terms of fund manager awareness to this consideration for over 2 decades now. And recently it has become more apparent where we have true dedicated mention in any credit research note of what the ESG value of that particular issuer issuance or security will be. But I think it's pushing a little bit further. It's also pushing us to realize that when we ask most ESG question from the issuers we're meeting, we are also likely, and indeed we're receiving at an increasing pace, more ESG question in terms of how we manage our own business. And I think that's quite interesting because it's also raising the bar in terms of asset manager and probably how asset manager can behave going forward in terms of treating obviously their employee fairly, but also the consideration in terms of how they do business throughout the world, the pricing of business, what is a fair price and what is extortionate price, and also a lot more consideration in terms of traveling and so on. So we're switching quite a lot of strategy and also strategic direction within the company, and I think that's quite good that people are going through this kind of level of details, whether it's through RFP or direct client visit, meaning us being the asset manager and prospective clients. So I think the consideration is moving fast. Obviously, it's moving fast for us, where all the quantitative strategy are now ESG aware, and I wouldn't be surprised if a lot of the active strategy in the coming month are also become more and more ESG aware. It doesn't necessarily mean that they're all compliant with a certain scale, and the scale has to be yet defined, but it's just under the precept that clearly that the company that we are investing in and are not doing things rightly over time will probably be penalized quite widely by the market. So there's probably not a great deal of outperformance to be expected from this company. Obviously, some companies are poor in terms of ESG scoring as they are today, but improving quite dramatically their ESG score and going in the right direction. And this company, I think, can deliver outperformance as well. So I think it's an extra consideration when we look at fundamental of any company, and they being very much bottom-up throughout Fidelity, that ESG has been within the DNA of Fidelity for over 2 decades, and it's going to carry on probably even with more awareness than we had before.
That's one of those areas where obviously you're adding a huge amount of value as an asset manager with that kind of thought process and that analysis. But quite often you can't add any value because your industry is being taken over by passive investing, by ETFs, by things that just don't go through that kind of rigorous analysis and just in general are eroding your fees. What can you do about it as an asset manager?
Well, I think it's an interesting consideration because it's true that Fidelity International book of business has been growing, not at a very fair pace, but at a steady pace over the last decade. But the challenges are quite multiple in terms of where we can grow the book of business going forward and how we can be challenged by some other part of the industry. We are ETF provider as well as active provider as well as quantitative strategy provider. So the continuum from active to all the way to passive is definitively offered within the Fidelity scheme, but obviously different areas will offer different pace of growth, just because we are mostly well known for being active portfolio manager, and that's where people will be calling. But I think it's quite interesting that with the recent consolidation, especially obviously the big headlines with Lloyd's, Scottish Widow against Aberdeen Standard Life acquisition, we have seen price pressure, but the price pressure I think is more defined by the lack of diversity of return between active and passive strategy, where we've been in this big conundrum where dispersion among asset managers has been quite low in terms of return. And that I think is about to change. I mean, we've seen bounce of volatility in 2016, a little bit more in terms of 2017, and the moment we can see that in between emerging market, developed market, or what we call the new world, the difference of return is starting to be quite dramatic. Whether you've been allocating tactically emerging market, let's say, in the G5, G7 kind of mandate, that could carry you a long way down, as we've seen year to date. So I think as long as the market picks up in terms of volatility and the dispersion of return mean that people are not, are producing truly outperformance and unfortunately truly underperformance in some cases, I think the fee consideration will be towards the more active, the more managers who are delivering this extra performance. And then where the client doesn't want or doesn't see or foresee any opportunity, that will be whole commoditized, and that's where I think there's space for passive strategy. So what we are doing quite often in most of our clients' discussion is, positioning these different asset classes where the clients think it is commoditized or it is not commoditized, and there's opportunity, and therefore we can exploit the full continuum as opposed to have some of our competitors exploring the passive or the less active strategy as we were doing before. So the company is developing on that front.
I think certainly on the first point to remember when we're thinking about active and passive is, of course, that most active managers will underperform before fees and many more will underperform after fees. So it is clearly a consequence of disappointment and ultimately probably overcharging, poor value for money across the asset management industry, which has led to this huge increase in passive flow. Having said that, active management still has more assets today than passive, and so those that believe that it doesn't have further to go, well, it potentially does. The question is sort of where does it end up? And I think from where I think about it, there's sort of a requirement. Passive relies on active managers to set the price ultimately, and so how many active managers do you need in order to set the price? And so I think it's an interesting question of what proportion of the overall market can passive take up. So that's sort of one thing that I sort of spend time thinking about. I don't have the answer to it, but it's probably a higher number than where we are today. I think in the US, something like 40% of assets are passive, and that number can certainly go above half. Can it get to 80%? We will see. There is, I think, also a distinction between ETFs and passive funds. So the index fund versus ETFs. Clearly, ETFs have a bid-offer spread, and passive funds, you have a net asset value which you can trade on each day. And so, these asset classes, for example, high-yield bonds, where people are investing in ETFs, assuming that they're going to have ample liquidity in an asset class that clearly doesn't have as much liquidity itself. I certainly am questioning the realities of a crunch if we see another sell-off in the markets, or a more substantial sell-off in the markets, whether or not we will see a dislocation between the prices that investors believe they can receive selling ETFs and the prices that they may actually receive when liquidity dries up.
I mean, there is a fundamental challenge, isn't there, in passive in terms of what happens in the event of a downturn, where if you are selling a salami slice of everything, you will push prices and you will have no capacity to say, I'm not selling that because it's now too cheap. But price is a huge challenge in all of this. And when one thinks that in wholesale terms, passive is essentially clearing the market at 0, smart beta clearing at 4 basis points in wholesale, it does mean that there are slim pickings for active, unless you can demonstrate consistent value added, where the FCA and the CFA believe that taking roughly a third of the net value added to the customer is a fair recompense, being the trade-off between the provision of skill and the participation of risk on behalf of the investor. Now, I think that's going to mean that we end up with far more small players, because implementation, I think, is going to then be the big issue. At the moment, active players can do very well with big cap, because it is some of the big caps that are leading the charge. If we go back to an environment where small caps deliver outperformance and there is an illiquidity premium associated with small caps, then I think small-size investor company is likely to become much more the norm.
It's basically, to Lucette's point, of more diversity of returns, but you're saying within an asset class rather than between asset classes.
Absolutely. Yes, I mean, the premise that we will get back to the index if we simply sum all the participants is just mathematically correct.
Does this mean that it's also mean that it's cyclical, that the passive-active balance is going to change as volatility returns?
I'd like to think there's a cyclical element to it. I mean, you've seen the premise of it starting in the first place was access to asset classes, so the plain vanilla sort of ETF, the AG, whatever you want to call it. But then now it's sort of breaking up into the more niche areas. So you're looking for specific, I mean, there's managed ETFs, there's actively managed ETFs now. So what you're seeing there is sort of the diversity. I mean, there's indexes. Actually, there's it used to be you could sort of get an app for anything. Now you can almost get an ETF for anything. There's indices which you didn't think have ETFs. I don't know whether any of you have heard of the gender diversity ETF, which sort of rewards companies that are good on gender diversity. Good intention, more from engagement than from the actual investment in the ETF. But it just shows you the level of creativity that's now taking place in that space. So I think the next leg won't necessarily be sort of the, fixed interest is another area of growth for them. But then you'll see more into the niche areas where they can sort of get that value, that sort of active value there. Because what you're seeing is, 20, 25 basis points. How low can you go to sort of create an ETF profitably and for it to be viable? So I think that in its own will force them to look beyond the sort of mainstream assets and go sort of more niche end.
Okay, so you're saying niche. James, you also say about smaller companies there.
I'm talking about a liquidity issue. I'm saying that there are no shortage of brilliant people in the field of asset management. What we have are fundamental issues of implementation. If you took everybody's paper portfolio, where they can look absolutely stunning, and try and put it into the market with $50 billion, it just doesn't happen because people can't trade. And I think there is another issue, which is the more we want to make asset management a science and less of an art, the less room there is for active managers. Because if you said, no, look, actually, we really want to know how you make decisions, if you can have a process that is written down that explains how securities are selected, how portfolios are constructed, you have actually taken yourself into the position where a computer can run the money and where you have a smart beta proposition. Then you have fees down to 4 basis points, not the active fees that active managers are used to taking.
Okay, so let's get to the big question here. What is the future then for the size of the asset management industry? Is it going to be more M&A, more combinations like Aberdeen and Standard Life, and the big players who can bear those massive IT costs? Or is it going to be the niche players who can offer the more esoteric particular funds? Bigger or smaller?
I think we're going to see more M&A. There's a lot of synergy within the industry which have not been exploited in the past. And I think there's more houses which need to combine to have a full-fledged offering as opposed to only a few items on the compound from active to passive. So I definitely think that the number of players, like we've seen in other sectors, have been far too many. And some of them, be it regulatory costs, increased research costs, or anything else, will have to combine in order to create slightly larger entity. Whereas some of the extremely large ones starts feeling the pressure and the pain in terms of how do they can shift the strategy. We've seen with PIMCOs and hovers, shifting large fund where there's a lot of transparency about the strategy through a period of slightly higher volatility. It was not massively high, but slightly higher volatility has been a challenge, and that has led to quite a lot of franchise departures. Something also that we are exploring, and it's quite interesting, I suppose, for an entity like Fidelity, which is truly independent from any banking and insurance affiliation, is that going forward with the development of fintech, a lot of people don't want to park their trade secret with their asset manager. Will they be affiliated to an insurance or bank company? Therefore, I think some detachment of asset management, which would be the reverse of what we've seen in the last decade, would be expected from what I see. So, Pioneer being one of them, but it wouldn't be a surprise to me when some of these companies have to be either asset manager or insurance company, but they're struggling to comply with both regulators, but also struggling to attract more clients when they're themselves maybe a big insurance company or a big bank being sponsored on the background. So I think we will see more migration and more M&A and a reduced number of players over time.
I think part of it is where we are in the cycle as well. So you have, I opened up my news feed this Sunday and saw 3 take over as 1, 2, 3. So Sky, Comcast, you had Virgin Money with Clydesdale Yorkshire Bank, You had also Allianz apparently looking for targets across Europe. So part of it is money is cheap. Central banks have seen to that. Mario Draghi is firmly stepping his foot down on interest rates. So within that sort of context, your funding costs are going to be cheap, at least on the debt
Generally
side.
for all M&A, not just...
All M&A. Across the industry as well, there's a lot of synergies as well, as Lucette touched on. So Standard Life Aberdeen, there's apparently 250 million worth. Finding how they execute that, whether they do so, is probably the next challenge as well. But you're seeing a lot of that sort of, I guess, come through the late cycle nature. But I guess, yes, the pincer movement of passive competing on cost and regulatory cost burden going up is quite key to this space. So you're probably going to see more people just putting their hands up for sale, or just looking strategically in how to sort of move forward, and that's probably a strategy.
It must in part depend on how one defines success, because if you were a small boutique asset manager, the capacity to outsource those parts of the business, the operations, the settlement, the compliance, which are relatively fixed cost and rising, is very attractive if your only interest is picking securities and running portfolios. And I would suggest, therefore, that the definition of success varies substantially between proprietary outfits, where delivering performance is typically the main focus, and the big banks who want large scale, and where sometimes the metrics of assets under management and customer acquisition matter more than the returns that they give to those customers.
Lucy?
I think we will continue to see consolidation, but I do also think there is a place for boutique managers. You know, in my sort of fund research role, the managers that I see outperforming over the long term are the ones that are absolutely aligned with investors and specialists in one particular area. And so there may well be cost synergies with the likes of Aberdeen Standard. As you say, whether or not they come through is going to be interesting to watch. But, you know, in terms of actual performance to clients, what will be the outcome? And there I don't know. You know, big firms, yes, there's lots to gain, but also actually the alignment that you get with really specific compensation structures, I think that gives me a lot more comfort when I'm investing with boutique managers.
We're running a little bit short of time, but there's one topic I do want to talk about, which is technology. We've kind of alluded to it as a cost thing, but I was reading a fascinating article about Man Group and their use of artificial intelligence and how that's revolutionising their approach. Lucy, what do you think about the role of that?
I think it's fascinating. I think, you know, it's we know probably the tip of the iceberg, and that iceberg is ever increasing probably every day. I think that there is, you know, whether it's a threat or an opportunity, I think it's probably both, depending on who you are. Certainly the work that I've been looking at, you know, there's the opportunity to, for example, use AI to effectively enhance your investment process. So you could decide that you have a specific set of criteria that you look for in either bond investments or equity investments, and you could set up a program that effectively looks for those in not just the data that you would look at yourself as an individual, but in endless, and you know, the big data that we all sort of know exists, but probably most of us don't really take advantage of. So I think there is an enormous opportunity to enhance the research processes of many investment houses, whether or not ultimately AI sort of ends up overtaking us as investors. You know, I suppose it is possible. You know, I tend to believe that there's still, you know, some benefits to human beliefs, whether that might be your kind of creativity or just sort of judgment, you know, looking somebody in the eye and that sort of thing. But I think that the involvements that we've seen over time have been clearly enormous in this area, and I think it will be a really, really interesting one to keep an eye on.
Mm-hmm. Artificial intelligence or the old-fashioned real intelligence?
No, I think it's like playing chess. There was a time when humans always won chess matches and computers made look rather foolish. The big AI computers now thrash people at chess, and I think it will ultimately be the same with asset management, I'm afraid.
I think as the data improves, you're probably going to see more intelligent algorithms. And right now, I think the limitations are more around data. I think that's the only reason why you're not seeing the likes of Google, the likes of Apple move into our space. But as that data becomes available, I think you'll get Siri and Alexa moving more into fund management, and that data is quite key.
The big difference is going to be in directly negotiated loans and in private equity, where working with businesses in order to add value is still going to be very much a human activity.
But in the more general ones,
Yeah, it's about availability of data. So any private market will, for the time being, have an advantage, or humans will have an advantage at least.
And we said on the technology point, what about the impact on the customers and the distribution channels? And
Yeah, I think it's changing quite rapidly, and it has already changed quite aggressively. So it is definitively a place where technology has moved the dial quite significantly. I mean, it's increasingly easier for any client, being wholesale, institutional, insurance, pension plan, to see what we're doing in real time, to see what's the portfolio positioning, which we used to publish like once in a quarter. They now have access to daily positioning and so on. But it's also for the wholesale and distribution. I think this new platform allow and the multi-manager platform also allow competition internally within the company and also externally upon product. I truly believe that the new generation also of wholesale customer is probably likely to be much harder to retain for a prolonged period of time, because they're, especially perhaps the generation which doesn't have the most amount of money but is growing, especially the millennials, will be quite acute to shifting everything else in their life at a click of a mouse. So I'm sure their fund manager will not be different. So in order to get this point where they are returning customer throughout market cycle, I think it's going to be a challenge for everybody. And it's already a challenge which is upon us. So we're more than prepared, but we're not fully prepared, I think, for the next decade to come.
any comments on that, or shall we throw it open to the floor? We've touched on a huge number of topics on MiFID, on compliance, on ESG, technology. Any of the topics that we've been speaking about, any questions from the floor? In that case, we've managed to answer everything that everyone was wondering, so, which is excellent. We're now going to move on to the next series of panels. In this room, ICBC are going to be hosting a very interesting session on the opening up of China's financial markets. In the ballroom next door, we're going to be looking at corporate funding. And then upstairs in the Crystal Palace room, we're going to start the bank capital stream. So please make your choices between those. Thank you very much for listening, and thank you. Please join me in thanking my panel for a fascinating discussion. Thank you.